Now that you have a better understanding of some of the risks, it's really easy to understand, why you want to invest in cryptocurrencies, because who wouldn't want to benefit from something that's gone up by, 37,000%? Who wouldn't want to actually go and buy some Bitcoin, which came out at, say, 1 cent, and at one stage it was trading at over $20,000 a Bitcoin. So people increasingly are looking at they want to get involved. We go back to a company that we mentioned in previous lectures called Coinbase. They actually took on 240,000 clients on Thanksgiving. They now have more accounts than Charles Schwab that was set up in the 1970s. So there's literally, at the last count, something in excess of 30 million people who are now buying and selling cryptocurrencies. So how do you get started? Well, the first thing you need to open an account. Very often, increasingly, and quite correctly, that involves you going through some sort of money laundering process. Are you who you say you are? What sort of identification have you got to prove that you are indeed Johnny Fry? We want to see a utility bill, we want to see maybe a credit card statement, we would like to see some sort of photo ID, it might be your driving license, passport, your military card, so they can then prove that yes, you are who you say you are, so that they can then allow you onto the exchange. You then have to create something called a wallet. A digital wallet. So it's very, very similar to what's in my pocket, but in order to be able to open the wallet, I need to have a password, because I need to make sure it's very safe and secure. So you come out with a 24 letter sort of passport opening key as your security code. So the first thing you need to do is make sure you keep that in a very, very secure place. Write it down, stick it somewhere that you're not going to forget you've actually got it, so that actually because if you forget your password, then you can't actually get access and retrieve your wallet. So you then have two types of wallets. You have hot wallets and cold wallets. So what a hot wallet is where it's directly connected into the internet. So it means you can trade there and then and move currencies from your wallet into the ether to actually trade and move and buy and sell currencies on an ongoing basis. Sounds really, really attractive. However, as soon as you actually connect to the internet, you don't know who's trying to get into your wallet. So you're potentially vulnerable all the time. Your money is hot. So it's a little bit like, go back to the very simplistic basis. If I leave my wallet on the bar, it's hot, it's available. People can see it. If I leave my wallet in the car, it's very easy for someone to smash the window, thanks so much, and disappear. So actually we've come up with a solution. And the solution is a very sophisticated thing called a USB stick. So essentially, you plug it out of the internet and then stick it in the safe. Stick it somewhere safe. Take 2 copies. So if you lose this one, you've got another one. So what that means is that once you're actually off the internet, i.e. a cold wallet, you can't trade immediately. You'd have to go back in to be able to trade. But most of the time, you don't want to trade. Unless you're an active trader, chances are you probably want to go in, make some selections and come out, and maybe once a day, once a week, once a month, then alter the things that you're actually holding. And by holding the majority of your money on a cold wallet like a USB or a hard drive that's not connected to the internet, then no one, the security and safety is as good as where you store this, which if you held it in a vault in a bank or if you held it in a safe somewhere, it's a very, very secure way of holding your monies. So now let's go back. We're on an exchange and we're trading. What you find in the cryptocurrencies is that there's something in excess of about 70 different exchanges, and not all exchanges will trade every single currency. So depending on the currency you want to trade, it will depend on the actual exchange that you need to have an account with. But you have this situation which is called arbitrage, which very, very simplistically means on exchange A, I can buy, let's say, Bitcoin at $10,000. On exchange B, I can sell Bitcoin for $11,000. So simply by buying here and selling here, I can make 10%. And that's called arbitrage. You're arbitraging the price differential between 2 different exchanges. And the typical price differential on something like Bitcoin can easily be between 5 and 20% on a daily basis. So if you're nimble of foot and if you've got sufficient capital that you can actually buy and sell, because the wrinkle in all this is very often that it'll take several days settlement between these two. So if you can afford to finance that difference, then you can actually make money out of something where both prices are going the same, they're not moving over a period of time, but you can exploit that price differential. So that's just a market inefficiency of an immature market, and will soon be exploited, and actually then the price differential will come in, so that arbitraging won't be possible. I suggest over the next few years, as we see increasingly sophisticated professional investors, hedge funds, institutional investors getting involved in this space. But nevertheless, at the moment, those sorts of opportunities exist. And then in terms of how do you make money out of cryptocurrencies? Well, I think what we can do is turn to equity markets. And it's been very interesting if you look at the statistics in the UK, less than 10% of the public own direct shares. Yet at the same time, we've seen a massive push and a huge amount of money being spent, not only in the UK, but also in the government, with personal pensions and 401k policies. So more and more people are actually exposed to equity markets, but it's held through a trustee, through a fund manager. The trouble is, 2/3 of fund managers don't beat the index. So 2/3 of the time, you're paying very high charges, and you're actually underperforming the S&P 500, the FTSE, the Nikkei Dow in Japan. So therefore, you've literally seen trillions of dollars going to Vanguard, to BlackRock, i.e. funds that will track an index. Billions of dollars going to ETFs, exchange traded funds. So where does that impact on cryptocurrencies? Well, in America, you have twice the number of mutual funds as you do stocks. In the UK, you have 50% more funds than you have quoted stocks. So what we're going to see over the next few years, you're going to see an increasing proliferation of funds that invest in cryptocurrencies. So it might be a fund that invests in European cryptocurrencies, or funds that invest in real assets, or funds that invest just in utility tokens, or funds that just invest in security tokens. They'll slice it and dice it as in the same way that we have in the equity markets. But one thing you can be certain of is you're going to see a lot more funds once the regulations allow fund managers to hold cryptocurrencies, because at the moment they're not seen as a recognized investment. But as they become recognized, then more and more people will migrate and just find the hassle of trying to arbitrage prices like I spoke about earlier on, or looking for the next ICO because you're pouring through all the white papers, or seeing that there's been, sort of from a technical analysis point of view, a big drop in the value of a coin. Well, leave that to the professional people that are doing 24/7. The problem is with cryptocurrencies is that they don't sleep. In the UK, basically, equity markets shut Friday night, 9 o'clock, when America turns off the stock market and everyone goes to bed and has the weekend. Equity markets then reopen GMT round about 6, 7 o'clock in Sunday evening when the Japanese stock market opens. So you've got Friday evening, Sunday morning, and all day Saturday when equity markets don't trade. So let's say the equity market's up here, and let's say some atrocity happens, some nuclear weapon gets thrown around, some disaster occurs. You could see a situation where the price of, let's say, British Petroleum is up here, or IBM, or Apple, or Google, because something's happened in this interim period, it basically does that. It just drops off a cliff. Now, one big advantage of cryptocurrencies is if it's up here, it'll have the ability to trade, and hopefully you'll have the ability to get out before it's actually fallen too much. So I think what we're going to see is a much more automation in terms of trading. You need a robot. It is physically impossible for a man or a woman to trade cryptocurrencies 24 hours a day, 7 days a week. So we're actually going to see more artificial intelligence, more robot trading, more technology being put on another layer of the technology, which many of these cryptocurrencies, as you know, are trading off something called blockchain, to actually enable you to be able to benefit from some of the opportunities that are out there in the marketplace. But meanwhile, my recommendation would be try and learn. The best way is to go and open up a wallet, see how incredibly difficult it is. If you're under 40, you'll probably do it like that. If you're over 40, just having as a sort of as a benchmark or a watershed, is you'll really struggle with it. How do I do that? Where do I put this? But if you're going to issue a cryptocurrency to some of your customers, you need to bear that in mind. You want your customers and your clients and your stakeholders to do something which is at the moment quite difficult to do. Whereas that's why I think we've seen a lot of millennials get involved in cryptocurrencies, because for them, they get a new phone and it's easy. Well, what's the fuss? I know exactly how to download an app and update it and everything like that. Whereas perhaps, you know, some of us a little bit older, we look at it and think, son, can you give me a hand to set my phone up, to make it link and all the rest of it? And it's very similar, I think, with cryptocurrencies. So there seems to almost be a natural adoption for younger people to understand the technology, and they're the people who've got engaged, and they're quite happy and they enjoy the trading. But be careful, it can be addictive, and what goes up very often will actually come down.